Well, welcome back to another episode of the Money Mentor podcast, the Chief Economist, Dr. Andrew Wilson. So, would you believe it, Doc? We're at Wilson Weekly number 92, episode 92.
We'll have to have balloons and streamers and everything when we get to 100. That's a milestone coming up soon. So hang on to your hats, everyone, for the 100th episode. So that'll be in about 8 weeks' time. Okay, it might be close to the Reserve Bank decision on interest rates, which is Melbourne Cup Day. So I'm doing some quick math there. So we'll see how we go. But that's a bit in the future. We have to deal with all today's news. And I'm in Sydney today, and it's going to be 26 degrees in Sydney here, which is boiling hot for Sydney, because Sydney's been seriously cold for a long time. I'm up and down and across, backwards, everywhere. But Sydney's really stood out as being a little bit chilly when I've been here. So that's good news that it's getting a little warmer. But of course, it's not just the weather that's getting warmer. It's also the housing market is getting warmer, which we expect this time of the year. Of course, we've only got 2 weekends left in winter for the winter selling season. And then we're officially in spring. But we've seen some early signs coming through with our auction results recently. And the auction results have been pretty good this year, to be quite honest. We really haven't had a serious sort of winter quieter period. And it's starting to bounce upwards. So, getting ready for spring. But that's in the future. We've got other things to talk about today. Some important economic news, of course, relating to our economy and how that backs its way into inflation, and how that, of course, is a driver of interest rates. And if we're talking about the housing market, front and centre, of course, is discussion about interest rates, where they are, where they're going. So we'll have a little bit of a chat about that. So I'm ready to go whenever you're ready. There they are. My housing market is my brand. We operate as independent commentators and data provided for the housing market, and we're all about the current state and future prospects of your housing market. And of course, we work very closely with Infinity, the Infinity Group, and we thank them for their relationship with us. And just going forward, it's been, I think we've been with Infinity the best part of 10 years now, as one of our important customers and clients. And of course, Infinity continues to kick goals in terms of what it's all about. But we're all about the housing market and our independent views on the housing market. And we bring that to you every week in our podcast. And it is all about the latest news that gives us that sense of the current state of housing markets. And so this is the week to Wednesday, August the 21st. So we're 3 weeks into August now. So well and truly at the back end of the winter market. And really starting to think about that spring revival, which comes every year. This week, we're going to talk about the latest labour market data. So last week, we had the unemployment rate, very important, because we've got to understand the Reserve Bank's not just about the inflation rate. It has a dual role. It's also to maintain, if it can, full employment with inflation in the target range, which is between 2 and 3%, and they use underlying inflation as their guide for that measure. So labour market is important. We're also going to look at house building costs this week. And that is important for not just those that are building a house, of course, and also for those that are looking for more supply in our chronically undersupplied housing markets. But it's also important for the inflation rate, because the Reserve Bank, or the ABS, uses the house building costs, now houses, not units, house building costs, as part of their housing costs measure for inflation. Now, I will go through this in a bit more depth when we get to that. So it is important, house building costs. And of course, as we've already alluded to, we'll have a look at the latest weekend auction results. So let's get going, shall we? We had last week, as I mentioned, the release of the July labour market data from the ABS. And look, even though it's maybe the headline rate was a bit, unemployment's rising, it was still a very strong labour market result. And So we'll just have a look at the headline data here. The June jobless was up again. That should be, the June should be the July jobless. We've got a typo there. The July jobless was higher again at 4.2%, following the June result of 4.1%. So the unemployment rate has ticked up a bit. It's certainly tracking now consistently above 4%, just above 4%. And that's well ahead of the sort of mid, even low threes that we had a year ago. But the low unemployment rate has been a problem for the Reserve Bank, because it realised that because we had such a short, and these are unprecedented levels of unemployment, of low unemployment levels, rates. In fact, we hadn't seen those sort of mid to low threes since the early 70s, and that was a completely different Australia. So the problem is that when you have such a shortage of labour in our labour market, then it means that workers are quite quite active in bidding up their wages, because they know there's nobody really lining up to take their place. Employers are forced to pay wage demands because of the shortage of workers. And if we're not getting productivity gains, now productivity gains means, okay, you can get your pay rise, but you sort of got to be proving that you're working that little bit extra or producing that little bit more to justify that wage increase. Because if you're not, the only way the employer can cover those extra costs through higher wages is to put up prices. And of course, that means higher inflation. And that's the last thing the Reserve Bank wants, of course, in the current environment where we've been going through higher inflation for some time, is to not have productivity driving wage increases, wage rises, because that means that it'll then work its way back to businesses having to raise their prices to maintain their profits to cover wages. So this you understand, this is why this is such an important factor in the Reserve Bank's battle against inflation. It is not to see a very low unemployment rate where we don't have the capacity for productivity gains because we have just such a low level of competition for labour. So we're sort of moved out of that area, which was the mid threes, low threes of a year ago, which was a big concern to the Reserve Bank. And we're now, as I said, just moving into the low fours. So that's actually still not a bad unemployment rate when we look at the historical series, which we'll do in a sec, because it's still, very low. It's at the sort of level we had during the mining booms. We had 4% unemployment rates. So it's still a very low rate. It still means that there's plenty of capacity for workers out there to leverage their employers for higher wages, plenty of jobs around still. So even though the unemployment rate was up, it still reflects a strong labour market. Now, it's not just speaking about the relative position of unemployment rates and the sort of theory behind competition for labour. It's the other data that came through with that unemployment rate that is particularly interesting and does reflect, what a strong labour market we do had. We had another increase, big increase in the number of jobs created. 58,000 jobs created over July, which was up following that 50,000 rise over June. Now, let's put that into context this year. So far this year, the Australian labour market has created over 300,000 jobs. So it is absolutely flying in terms of jobs growth. And of course, a principal driver of this is migration. We've had a surge in migration since the lockdowns finished, since we opened our borders up, and those migrants are finding jobs. 300,000 new jobs this year. So the actual creation of jobs is quite remarkable this year so far. We've had a rise in the number of unemployed. That was up 24,000 following a 10,000 rise the previous month. But obviously the net position is that we're creating jobs far quicker than we're losing jobs in that sense. Now, the real, principal factor in a higher unemployment rate was the participation rate. Now, the participation rate is an important measure in the workforce because, we've got to understand that the size of the workforce changes from period to period. And according to the size of the workforce, because that's what we're measuring people unemployed in against the size of the workforce, right? Now, the participation rate measures the proportion of those that are in a job that are, as the ABS measures, being in a job. And that can be, anything up above an hour's work a week. But nonetheless, that's the measure. It's standard. So we can use that as a standard to compare how our economy is going on a month-to-month basis. So it measures that against the potential workforce. So that's the population basically over 15. So they're considered to be the potential workforce. So at the moment, we've got 67% of the potential workforce, 67.1% of the potential workforce are actually working as defined by the ABS. That is an all-time record high for Australia. To have that proportion of the workforce actually working, or the potential workforce actually working, is quite remarkable. So it shows that we're dragging more and more people into work from the potential workforce. And of course, that includes all the migrants coming in as part of that potential workforce, which is growing potentially. Potential workers are growing, but we're also seeing that translate into actual jobs, at the highest rate ever. So this is very, very strong result. And, again, reinforces that in a way we've still got work to do in terms of, making sure that we're getting wage rises based on productivity gains, and that, there's plenty of competition for, that there's more competition for or between workers out there. So, and we keep a lid on prices. So the Reserve Bank would be happy with these figures, but nonetheless, of course, it shows a very strong economy, which is what the Reserve Bank wants. And now it can sort of focus, on the main game in a sense, which is what happens with inflation as the outcome to these other factors. So despite all those higher rates, despite the migration, we're only seeing a modest upward trend in the unemployment rate. And a lot of that is because our actual workforce is the proportion of our workforce in work from the potential workforce is the highest it's ever been. So even though I guess people say, unemployment rate up to 4.2%, it's tracking higher than a year ago, it's trending upwards. You have to look at the detail behind this to understand that we still have a very strong economy, and that this is actually good news for the Reserve Bank because it's sort of a not as tight our labour market as it has been. So hopefully that means we won't have the same pressure on employers to raise prices, and therefore putting upward pressure on inflation, which of course would put upward pressure on interest rates. So a good news story, I think, all in all, from our latest jobless rates, our latest labour market. And you can see there the trend is just, when we look at the long-term series, the trend is just starting to head north. But when we look back over the previous period, we're still tracking around about, we're higher than we were during the mining boom in 2010 up to 2012. And we're around about where we were in the great mining boom in the early noughties or mid to late 2000s. And so it's still a low number. But as I said, we have a record proportion of the potential workforce actually working. So that's a factor that's very important to note. When we look at the relative positions, interesting here. No surprise, Western Australia has the lowest unemployment rate, 3.7%, still in the threes in Western Australia. Not up a lot over the past year. It just shows you how strong that Western Australia economy is. And of course, part of what's clearly driving the Perth housing market is that very strong economy. And we'll look at wages next week, latest wages and incomes data, and we'll see there that Western Australia is certainly has the highest incomes and the highest growth in wages, reflecting that strong economy, low unemployment rate, but also part of what's helping buyers, afford to, be in the housing market, the Perth housing market, because their incomes are high and certainly their prices are still considerably lower compared to particularly Sydney. So therefore they have that affordability advantage, which means they can continue to push prices up within the boundaries of the bank's criteria. So Western Australia, number one, 3.7%. And at the other end of the scale, Victoria, which interestingly enough, the Melbourne housing market's been that sort of underperformer compared to the other capitals there, or the other capitals in the states there. 4.5% unemployment rate in Melbourne, in Victoria. So look, the Victorian economy, no secret, hasn't been going as well as the other economies, but we've got to understand that Victoria is still a strong destination for migrants. So part of their issues would be, a load of migrants coming in, needing to find work, which may be just pushing that unemployment rate up, and high numbers of migrants coming in as usual to particularly Melbourne. So a little bit of a reflection on housing market performance when we look at the labour market performance on each of those states, with Victoria clearly the highest there, and Western Australia clearly the lowest going forward. So that's our labour market report. So that's, I guess, our economic update. Next week it's going to be very interesting because we will have the latest inflation data out, the monthly inflation data, which we take a lot of notice of course, but the Reserve Bank's been pretty clear that it's waiting for that quarterly data set in terms of its decision making. And that's why a lot of observers are talking about that November will be the date, if there is to be any change in the interest rate, because the next quarterly data for the September quarter for inflation won't come out until the middle of October. So it'll be just before the Reserve Bank meets. So it'll be interesting. And I would suggest that would have to be a fundamental, shift in the inflation position for the Reserve Bank to act, if it's only going to be acting on the quarterly data. But we will look next week at the monthly inflation data, which will add to our picture in terms of what we've seen today in the latest monthly labour market data. So house building costs, we sort of alluded to this at the beginning of the show. House building costs are important, not just for those that are building a house, not just for the building industry, but also for our inflation rate. It's interesting that the ABS uses house building costs as part of its measure for housing costs, right? It doesn't use apartment costs. It's only house building costs as a contributor to the price of housing. The other factor it uses is rents. So they're the two key drivers of housing in the basket of goods that the ABS uses for the inflation rate. Now, what's interesting about this, and of course we know housing's been a big driver of inflation, particularly high rents, but also certainly high building costs have helped to push inflation up. And it's been an interesting factor because our inflation rate is higher than a lot of other advanced economies, particularly the US. The US inflation rate is tracking at around about 2.4% at the moment, underlying inflation, whereas we're at 4.2%, our underlying inflation. So we're well ahead of the US. And one of the factors is our housing market, or our housing costs in the basket of goods. And the reason it's different is because the US do not count house building costs as part of their basket of goods, right? Whereas we do. And we've had a unique issue with house building costs in Australia because the previous government put through that home builder policy to deal with COVID. If you remember, there was big handouts, incentives for those to build a house or to build a home. And that caused an absolute rush of demand. and we just didn't have the building materials or the labour to meet that demand. So house building costs went through the roof, let me tell you. And that was a significant part of what pushed up overall housing costs in the inflation rate. Now, our rents went up as well, but so did rents in most other developed economies. But it was definitely what happened with house building costs that was a differential between us and other similar advanced economies in terms of our inflation rate outcome. So what I'm saying is this is an important thing to keep track of, because we are interested in inflation, because we are interested in interest rates and where they're going. So not good news for house building costs over the latest data, which was the June data. We actually saw house building costs. Now, this is the My Housing Market quarterly index of house building costs. It's derived from ABS data. You can see how the quarterly data set there from quarter to quarter has, this is over like a quarter, but measured month by month. You can see there how it absolutely skyrocketed as a result of that home builder allowance policy from the previous government. Skyrocketed, started to show clear signs of growth levels easing until recently. And we've just had a bit of a bump up over the last couple of months with house building costs, which is a concern that having seen it starting to moderate the cycle for quarterly house building costs measured every month, we're now just starting to see those house building costs tracking upwards again. Now, the important thing is, what is the annual rate of growth on a quarterly basis? So this is the rate of growth that we have. So this is taking over a year, each quarter, and comparing it to the same quarter over the month the year before, if you understand what I mean. So it's tracking every month the change in the quarterly index. So at its peak there, we were actually increasing by 23% a year. So that's just ridiculous, 23%. But that was the too much demand and just certainly not enough supply to match that demand for new houses. So new house costs went through the roof, but we started to see it gradually track downwards. And we're now down at 3.1% annual growth, which isn't too bad. We've sort of held the line over the past year when we're comparing year on year. So even though we saw a rise in the index, it's a relative position compared to where it was a year ago. So it also rose a year ago. So that means our rise wasn't as big. So it was only a 3.1% increase. Now, having said that, 3.1% is still a significant rise compared to what we would typically experience before COVID, but it's a lot better than what we've had. So some mixed news on house building costs. A lot lower the annual growth rate than where it's been, but just signs there of it starting to pick up again. So we need to keep an eye on it, and that's why we do keep an eye on this, just to see how we're tracking. But one of the significant factors, of course, in lower inflation that we have had has been the lowering of house building costs, the annual position of house building costs. So still continuing, but a little bit of work to be done going forward. So economic news out of the way, let's have a look at the housing market now. And of course, when we're just thinking about house building costs, it's also important that becomes more competitive so we can build more houses. So builders, aren't having to, they already have to pay a lot more than they did 2 years ago, but, they want to be able to have a bit more certainty about the outlook for building costs for houses in terms of their growth rates. It certainly is looking better now, but that doesn't mean that overall costs are still not high, because they are. So the latest weekend auction results, we really are seeing the spring market beckoning now. We saw auction numbers on the rise and the number of auction sales on the rise last weekend compared to the previous weekend. And that's what we typically expect as the spring market approaches. It doesn't sort of just happen when we hit September. It builds up over November. where we do see higher numbers of properties coming in to the market. And we also see not a levelling out in terms of lower clearance rates per se, but we also see higher numbers of sales. So buyers and sellers are still active. In fact, they're more active now than they have been in recent weeks, recent weekends. And that's the sign of the spring selling season on its way. So let's have a look at those results. We expect those to continue to rise over coming weeks. Big result in Sydney on the weekend. Sydney hosted 809 auctions. That was a huge rise from the previous weekend, where it had 686 auctions compared to the same weekend last year, 729. So still tracking well above where it was a year ago, and that's been a trend really all year with our auction markets. We've seen a real flood of seller activity, of listings coming in. And earlier in the year, it was at sort of near record levels. Sellers really quite happy to engage the market. So 809 auctions in Sydney, and a very positive clearance rate in Sydney, 71.9%, which was well ahead of the previous weekend. So it shows that buyers got their skates on last weekend as well. They responded to higher listings out there, and a good clearance rate of 71.9%. Not as high as the same weekend last year, when we were still in the midst of that recovery boom that most of our markets were experiencing a year ago, on the rebound of the market that occurred following the downturn in 2022. So a good result there for Sydney. Melbourne around about the same as the weekend before for both listings and clearance rates, and not too far away from a year ago. Higher listings than a year ago, clearance rate a bit lower. But Melbourne's been quite a steady market, certainly not performing as the stronger markets have been with higher clearance rates. But listings have held up, and the market's still tracking in those mid to high 60%. It's a fragmented market, as we talk about that here frequently. It's really, the Melbourne market's still finding plenty of buyers for budget-priced and mid-priced properties, particularly out to the outer east and the northeast of the city. And the west of the city, plenty of buyers there. It's really the inner suburbs that have been struggling a bit in the Melbourne market. The prestige markets have been dragging the chain, and that's really been a key to that Melbourne underperformance. But certainly budget and mid-price market areas in Melbourne, markets in Melbourne, are continuing to perform reasonably well. And as I said, a steady result there for Melbourne last weekend, and I expect those listing numbers to really pick up over the coming weekends in Melbourne. We just need to keep an eye on what the clearance rates are. Big weekend in Brisbane, a flood of listings in Brisbane, 120 auctions. Clearance rate was up in Brisbane, and the clearance rate, although lower than a year ago, again, that very strong Brisbane, and all markets were strong a year ago, still lower, but the number of sales was higher because of the higher listing numbers when we convert that with the clearance rate. Adelaide down a little bit, auctions about the same, clearance rate down a little bit. We thought we were back in town with those 80% plus clearance rates from Adelaide over the past couple of weekends, but it's tracked back. That's still a very strong result for sellers there, 75%, but not quite what we're used to or have been used to in Adelaide, but very much still a seller's market. And I think that Canberra market's now starting to consolidate its revival. Another 60% clearance rate in Canberra, with higher listing numbers, big clearance listing numbers, and well ahead of where it was a year ago, and similar clearance rates. So we've got some confidence in that Canberra market, just starting to build a little bit of momentum, got some way to go, but certainly it was a clear underperformer at the end of last year. And it's just worked its way back into a more of a positive environment for sellers over the past month or so. So that's our latest auction clearance rate results. More listings, clearance rates holding, which means more sales. So this is clearly, hello, it's spring, it's coming. So this is that clear indication. And we would expect, as I said, higher listings, particularly in Sydney and Melbourne, to be a feature of the market over coming weekends. These are our trends. Sydney down a little bit over August so far, But with that better clearance rate on last weekend, I think that we'll start to see that pick up again. But the only 60% result, and that's so far over August. We've got 2 weekends to go. But it's still been a very positive market in Sydney with all those 70% until recently. Melbourne's actually had so far a good result in terms of its clearance rate. It's tracking as high as it has for 6 months. So let's see if those higher listings will continue to improve the market in terms of clearance rates. Brisbane keeps on keeping on. It's well ahead of where it was over the past 2 months. So still plenty of energy in that Brisbane market. We know that anyway because prices are continuing to grow, and anything over 50% in Brisbane is certainly a seller's market. It has a different auction culture there compared to the other capitals, as we mentioned every weekend. Adelaide just picking up a bit so far this month after a little bit of a falling away last month. And as I said, Australia's strongest auction market continues to be Australia's strongest weekend auction market. And there's the Canberra result, which should give some confidence to a revival in that Canberra market, certainly picking up following that weaker July result, which I do think had a bit to do with school holidays anyway. But some good news there continuing, or better news continuing there for the Canberra market. If you're looking for those auction clearance rates every Saturday night on my LinkedIn channel, Dr. Andrew Wilson at LinkedIn, you can get the headline results of all the capital cities at around about 6:30 p.m. on my LinkedIn site. And if you're looking for the full national report, that comes out on Sundays. That includes the regional breakdowns for Sydney and Melbourne. So you can see how those capital city regions are performing in terms of auction numbers and clearance rates. And it also gives you the top 10 sales under the hammer for that weekend for each of the capital city markets. So lots of info there. Again, on my LinkedIn site, Dr. Andrew Wilson at LinkedIn. On Sundays, the full report and the snapshot Saturday night. If you're looking for a very good value, and we know that it's a very reliable forward indicator of what happens in our housing markets is what happens every weekend in our auction markets. So get a hold of that, and we speak about our auction markets regularly here, and that's because it gives us insight and we can provide commentary on what is happening here and now in your housing markets. So that's the QR code, which will give you a link to a PDF file for the latest national full national weekend auction market report. As we always finish off, we're going to finish off today. Just a quick ad for our app, the Infinity My Housing Market app. You can get an access to it with that QR code. If you want to, once you get the QR code and the access, it will ask you for a password. So get onto Infinity. They will give you the password to this app, but it's a great little app to have on your phone or on your computer. You can, in real time, look at every suburb that has data is listed in this app in Australia, and it is revealing asking prices and asking rents, current asking prices and asking rents on a daily basis, and you can filter it for the capital city or the region. We've done it on the screenshot there for Sydney. We're looking at Blacktown. You can filter it for the type of property, townhouse, unit, or house. And you can also filter it for the number of beds. And then that's the results you get, which we've done there on that screenshot. You have the median price, the high price, and the low price. So not just the median price. You can see the range of prices for that particular suburb and the number of properties that are for sale. And we do exactly the same thing for the rental market. So there's a good little thing to have if you're looking for insights on a real-time basis on the housing market. But you've got to get that password through Infinity. But it's a great little app, which we will be updating soon. We say that all the time, but it will come. Don't worry. So next week, we've already mentioned the July inflation data. We're also going to look at the latest wages and weekly earnings. Very important insights there in terms of the outlook for interest rates and, of course, the latest weekend auction results. So if you're looking for the full report today, there's the QR code for today's report if you're looking for a PDF copy of that. So you can take a picture of that QR code, a pic of that, and it will give you the link to the PDF file. So that's all from me today. Episode number 92.
93 next week, Doc. Looking forward to
93, yeah. I'm counting down to the big 100. I'm excited. So good to chat today, and we'll catch up with you next week.
Very good, Doc. Thanks once again, and we'll catch up next week.
My pleasure.
Talk soon.
See you, everyone.